So a very nervous environment for Forex, for currency traders in Q3 as we are post-Brexit, and it's hard to see how we're going to find clarity on the issue. In the meantime, the ball has been set rolling in terms of confidence, in terms of actual capital flows that are affected, especially in the property market. And we're likely to see sterling considerably lower in the quarter, though increasingly as we are getting sort of beyond fair value, beyond the short term, we're going to see high risk of big counter-trend rallies in sterling on ad hoc headlines as we see the ebb and flow of political headlines on where this is all taking us. But in general, of course, a negative tone for sterling in the quarter, and a negative tone we feel, and a nervous tone at least, for global markets. The ongoing Chinese currency devaluation has us looking in broad brush terms at safe havens. Where are the safe havens here? And where are the weaker currencies? The weaker currencies are riskier currencies, the commodity currencies in particular. Of course, sterling grouped with that as well. On the stronger side, it's a bit of a tricky environment to navigate. I think we've got a dollar now that is going to be the preferred safe haven. We have a setup we're calling the good, the bad, and the ugly of safe havens. The good being the dollar, endless liquidity. Its character has taken a different shape now. Euro, of course, is the bad safe haven because we're facing contagion risks, existential longer-term problems with Europe as well. We have a possible banking crisis coming into this quarter. And the ugly is the Japanese yen, clearly the outperformer when the negative dynamic is in operation, but also we're clearly barreling towards the next intervention phase from Bank of Japan, possibly in combination with Abe on fiscal measures. So the yen could head considerably stronger, but it could be sort of a spike during the quarter, and we could see that spike yield suddenly to weakness if intervention, new helicopter money policies, whatever form the intervention takes, is forceful enough, possibly around that July Bank of Japan meeting, but certainly at the September meeting we would expect the Bank of Japan to be getting very active in intervening and bringing something new to the table to risk the deflationary dynamic and the risk to the Japanese economy from a sharply stronger Japanese yen. So we could be caught in a very volatile and somewhat range-bound quarter as we see some of these moves establishing, but generally preferring dollar strength and preferring the riskier currencies to be on the weak side for the quarter.